Good afternoon and welcome to this afternoon's event on whether the world's central banks are running out of road. It's my great pleasure to welcome you, and it's my particular honor to welcome our highly distinguished panel of monetary experts. I can't think of a better panel to discuss this issue. In the order in which they're going to speak, they are Don Kohn, who's presently a senior fellow at the Brookings Institution, as well as an external member of the Bank of England's Financial Policy Committee. He was, of course, previously the vice chair at the Federal Reserve Board of Governors. He'll be followed by Claudio Borio, who is presently the head of Monetary and Economics Department at the Bank for International Settlements, that is, Bank for the World's Central Banks. Following Claudio, we'll have Adam Posen, who is the president of the Posen Institute of International Economics. Adam, amongst other things, has considerable expertise on the Japanese and German economies, and he also served as an external voting member of the Monetary Policy Committee at the Bank of England. And last is my colleague, Steve Kamin, who is resident fellow at the American Enterprise Institute and was formerly director of the Division for International Finance at the Federal Reserve Board. By way of introduction, I might note that since September 2008 Lehman bankruptcy, in the world's advanced economies, an extraordinary burden has been placed on monetary policy to support the global economic recovery. In bearing that burden, once interest rates reached their zero lower bound, the world's main central banks have been forced to resort to a prolonged period of ultra-unorthodox monetary policy. These unorthodox policies have included several rounds of massive government bond buying, the use of negative interest rates, and even the purchase of high-yield bonds. One indication of the extent of the central bank's bond buying program has been the staggering increase in the size of their balance sheets. Indeed, since 2008, the combined size of the balance sheets of the Federal Reserve, the European Central Bank, the Bank of Japan, and the Bank of England has been around $18 trillion. These central banks have all now become dominant players in their country's government bond markets. Among the consequences of the central bank buying activity has been a striking decline in long-term interest rates. Today, 10-year US Treasury interest rates are close to their lowest levels on record. Meanwhile, in the rest of the world, we now have more than a record $17 trillion of bonds bearing negative interest rates. Yet, despite the massive monetary policy stimulus, even before the pandemic, central banks struggled to meet their inflation goals while risks to financial stability mounted. Indeed, we have substantial inflation in asset prices like equities and housing, a troubling increase in household and corporate indebtedness, and a very strong compression in credit spreads on higher risk bonds. These concerns have only deepened this year with the record surge in global equity prices following their COVID-19 sharp decline at the beginning of the year. As a result, the Bank for International Settlements is now warning of the risks to the world economy from the daylight between elevated global equity valuations and persistently uncertain economic conditions. In the period ahead, it is more than likely that the world's central banks will continue to be called upon to play an important role in supporting the global economic recovery. This would especially be the case if the dark COVID winter, about which the health experts are now warning, would have caused the world economy to have another leg down. It will also be the case should governments in Europe and the United States be reluctant to engage in additional budget stimulus policies. All of this has to raise three key questions. The first is that in the event that we were to have another global economic downturn, would the world's major central banks have enough ammunition left in their arsenal to once again come to the world's economy's rescue? The second question is, with both short and long-term interest rates already now very low, might the policy instruments that the central banks do have left in the arsenal be less effective than they were before? And the last question is, even if monetary policy might be effective in securing a short-term global economic recovery, might there be a risk that it does so at the cost of creating further asset price bubbles and at the cost of further distorting credit markets? So without further ado, I'll yield the floor to Don Kohn to share his views on these key questions. Don, over to you.
Thank you, Desmond, and thank you to AEI for inviting me to participate in this event. I'm looking forward to the discussion this afternoon with you and a number of old friends that is great to see again. So I expect a rapid but incomplete recovery in the second half of the year as the vaccine is distributed, people become more confident. I think the economies, at least in the developed world where the vaccines are distributed, will bounce back pretty quickly. But I do expect the recovery to be incomplete. And I think we'll be looking at some scarring issues, both on the supply and the demand sides of the economies. So on the supply side, there will be sectoral shifts that make some suppliers of labor and capital will be outmoded. We'll need to shift from one sector to another because we won't come back to exactly where we were a year ago. And it'll take time to reallocate both labor and capital. But I do think that on the demand side, there will also be an incomplete rebound, at least for a while. I think people will be cautious in their spending. Businesses will be cautious in their capital investment after there'll be some catch up from pent up demand. But once we get through that, I see some lagging demand and continued muted pressures on inflation, even in the near to medium term. Though I do think, and I'll come back to this in a second, there are greater risks of inflation rising in the medium to longer run, and that's going to present challenges for central banks. I would say one of your questions, Desmond, was do the central banks have enough ammo if there is a significant shortfall in demand? Not so much over the next few months. I think that's baked in by, as you called it, this dark COVID winter. There isn't a heck of a lot monetary policy can do about that. My focus is on the summer and the fall and the next couple years. And even there, I think if demand is going to fall short for at least the medium run, I think the ammo is limited. The Fed has already deployed we're going to keep interest rates low for a very long time, partly by changing the framework for its inflation targeting to talk about average inflation targeting over time, reinforcing the low for long. They're going to have at least some period of over 2% inflation. They could extend the duration of their bond buying, or they could fix Treasury rates, the yield curve control by the Bank of Japan. But these rates are already very low. Markets expect them to remain low, and you have to wonder how much additional effect that could have. The Fed has ruled out two instruments that other central banks have used, negative interest rates and subsidized lending as in the Bank of England's or the ECB's kind of funding for lending. We'll lend you money if you make loans to small businesses. We'll lend you money at subsidized rate, make loans to small businesses. So it would be good for the Fed to explain why it's ruled those things out and how strongly it's ruled those out. But I think the answer to your question about is there a lot of ammo, the answer is no. And if there is a significant shortfall, that means we're going to have to turn to fiscal policy. And that's exactly why Jay Powell and the other members of the Federal Reserve Board and the Open Market Committee have been leaning so hard on the fiscal authorities to do their part to get us through the dark COVID winter, because they know their ability to do that is quite limited. I listened in on an event that Adam Posen was moderating in part, and I thought Larry Summers had in that event had an interesting proposition. So he said, benevolent central planner here would have a lot of fiscal policy investment. We've got negative real interest rates now for the Treasury Department. Surely there are a lot of investments that the federal government could make that would have positive real returns. Not only infrastructure, education, retraining, investments in people, as well as in capital and capital. So his proposal was that given these very low long-term interest rates, that this investment be funded at very long term. And he noted that the Fed's QE was doing exactly the opposite of that. It was buying up Treasury paper and issuing Treasury longer-term paper, immediate longer-term paper, and issuing overnight liabilities, that is, reserves on the books of the Federal Reserve. So his proposal was to really suspend or wind down QE, but engage in a lot of fiscal policy investment. Now, I think the chances of that happening in a closely divided Congress are small, but I was encouraged actually at some of the clean energy investments that were included in the bill that just got through the Congress. So there may be something for that, but I still think there's going to be some call for demand management and pressure on the Federal Reserve. But I want to move to the medium to longer run. So I think Summers' proposal pointed to two interesting things. One is to think about debt management, including the Federal Reserve's QE. But the other is, of course, that would result in an even larger federal debt overhang coming out of the recession. And that brings me to my final point, which is I think they're going to be looking in the medium to longer run. I think I see pressures on the Fed, if there is, that could give them, that make them hesitate to move against inflation pressures, a slow, hesitant response if inflation pressures do arise. And I think there are reasons to, that's not my modal forecast, certainly not in the near to medium run, but over the medium to long run, we've seen interference with some of the forces that have put downward pressure on inflation, globalization, demographic shifts, could be changing. And that might move the other way. And I think the issues will be political, but political interacting with the Fed's new framework. So thinking about that federal debt level, if those interest rates start going up, if they go up because growth is really good, that's not a problem, right? Because revenue will be higher, et cetera. But if interest rates start going up because inflation is higher and the Fed decides it needs to move against inflation, there's going to be huge political pressure on the Federal Reserve not to make those actions. But the second thing, I think, is the Fed's new framework for monetary policy. The emphasis in that framework has really shifted from price stability to full employment, and including full employment by various subsets of the labor force. Now, under inflation targeting in a book that Adam was the co-author of with Ben Bernanke and others. The Fed's implementation of full employment derived from its idea of how full employment could be in order to achieve price stability. And I think the new framework still has that, as articulated by Rich Clarida. He said something similar: the highest level of employment that does not generate sustained pressures that put the price stability mandate at risk. But I think in the new framework, there's just much more emphasis on employment and the full employment goal of the Federal Reserve. They said there'll be no liftoff until both full employment and 2% inflation are achieved, and that end is important, and it was emphasized by Clarida in his speech. So they need both of those things. And there's a lot of reference to the labor market of late 2019, early 2020. So getting back to 3.5%, 4% unemployment rate. So it has a bit of a feel. It's not technically right, but has a bit of a feel of almost an independent full employment kind of mandate they're going to be aiming at. I think the bulwark against, and if they start tightening before unemployment gets down towards 3.5%, there's going to be added political pushback from that as well. So I think the bulwark against encroachment on independence, political pressure, is that inflation target, the price stability mandate in the Federal Reserve Act. I think the framework to redefine it as average inflation targeting around 2 is fine. And that framework was well adapted to the post-global financial crisis world where there was very low interest rates and a lack of inflation pressures. But we don't know where full employment is, and we'll really only find out when after inflation begins to pick up. It's important to hold firm on that inflation target. And I think the Fed needs at some point to reinforce the inflation target and to acknowledge there are two-way risks on estimates of full employment. Yes, the estimates of full employment came down over the last 4 or 5 years, but they could go up again, especially if there's sectoral shifts in the economy. Thank you, Desmond. Those are my comments.
Well, thank you very much, Don. You've already covered a lot of ground and raised a lot of issues. Do I understand you correctly that you're concerned on the medium term that because of the situation of the budget deficit and the high level of debt, that the Fed might be under a lot of pressure not to raise interest rates? Might I also ask, would the fear that what they might do is they might trigger risk off in markets, and kind of cause the same kind of problem that we had for the emerging market economies? We've also got that kind of difficulty right now, that many of those countries are relying on very low interest rates. And you'd get capital flows out, so you could get a problem on that score as well.
So I think, but let's be clear, the issue would arise if inflation were rising past their 2% average targeting. And so they say it's okay to overshoot 2% by a moderate amount for some time, undefined what some time is, in order to anchor those inflation expectations. So I think the issue would arise if inflation started arising by more than they were comfortable with, and then they were trying to tighten. There'd be a lot of political pressure from that, and a lot of political pressure on the labor market side. And I think that would create a bunch of uncertainty about what the reaction function of the Federal Reserve was, where all this would end up. Some of us came of age in the from a central banking perspective in the 1960s and 1970s, and that scarred me anyhow. That my adolescence in central banking from 65 or from 70 to 79. And that was not a good time for financial markets. The stock market did horribly when there was a great deal of uncertainty about inflation and the willingness of the authorities to take the action needed to control it.
Thank you. I can only say that I'm sorry that the Fed won't be enjoying your wisdom when that time comes. You need people with that kind of experience that, inflation isn't dead forever. We can have that returning. With that, let me pass it on to Claudio. And Claudio, the floor is yours.
Well, thank you, Desmond. I'd really like to thank the organizers for the kind invitation and the possibility of sharing the panel with some old friends. You have raised three questions, which I think reflect very well the challenges central banks are facing these days. I've been working for the central banking community for something like 30 years, and I don't recall more challenging times. Three questions, slightly paraphrased. Let me just give you the answers. Have central banks run out of ammunition? No. I'm really paraphrasing them a little bit. Are the weapons they are using less powerful than those they had before? Probably yes. Would their large-scale deployment lead to financial imbalances? I'd say that more generally, it has been recognized that the deployment does not come for free. So before I launch into the rest of my presentation, let me stress that the views I'll be expressing are my own and not necessarily those of the BIS, for which you have to look at some of the publications that I will be referring to. So have central banks run out of ammunition? It's no secret that the room for policy maneuver has narrowed considerably over the past decade. Let me just give you a few numbers. Take interest rates and yields. In nominal terms, policy rates are hovering around zero in many countries around the world, including a growing number of emerging market economies. In some cases, including Switzerland, where I live, they're actually highly negative, 75 basis points. As you mentioned, something like 17+ trillion dollar worth of tradable debt, public and private, is yielding negative returns, and that's approximately 1/4 of the liquid stock. And as far as I know, the rates we're seeing these days are truly historic and unprecedented. I've gone back to at least the 1300, and I couldn't see anything like this. Now, in real terms, despite very low inflation, interest rates have been not lower, well, they have been negative for longer than during the great inflation era. Now, if we turn to quantities, you mentioned central bank balance sheets have been reaching new peacetime highs. For advanced economies, this is mainly as a result of purchases of domestic currency debt. For small open economies, including a number of emerging market economies, mainly as a result of the purchase of foreign currency securities, something like, in the case of Switzerland, foreign exchange reserves are of the order of 100% of GDP. But even in those countries, the purchase of domestic assets has been growing, including in emerging market economies. Now, balance sheets of this side, central bank balance sheets of this side, are not historically unprecedented. But that tended to happen only around wars, and so far, we have not had one, thankfully. Now, technically, of course, there are no obstacles to how far central banks could go. The zero lower bound on cash could be overcome. Think, for example, of the introduction of central bank digital currencies. And there are really no limits to how much assets central banks can buy. Even if they buy the whole stock of a particular asset, they could actually take positions on derivatives and effectively short that asset. So the limits are not technical, but they're clearly economic and political. Political because the more central banks move in that direction, the more de facto they encroach in fiscal territory. And economic because the more central banks move in that direction, the more they move away from the principles of a market-based economy with Posen, which I think we're all familiar with. An example that combines these two is central bank digital currency, for instance. There was a recent central bank report on CBDCs that basically puts forward as a key principle for their adoption that they should not be thought of as substitutes, but as complements to cash. We suggest that as of now, there is no intention of pushing interest rates below zero. So let me talk a little bit more about the benefits and the costs, or the impact and the possible limits. In terms of the impact on economic activity, I think looking back, arguably, unconventional monetary policies have been more powerful than originally expected. I'm sure we all Remember the famous quote by Bernanke, QE works in practice but doesn't work in theory. Moreover, their use in response to the COVID crisis has shown just how powerful they can be. They stabilized the financial system, they prevented the economy from going into a tailspin, and more generally, they have had a lasting impact on financial conditions, which are the key transmission mechanism for monetary policy. Now, to the point, markets have responded so strongly, which, as you mentioned at the beginning, there have been clear questions about whether markets there is daylight, so there is a disconnect between financial markets and economic prospects. Now, looking further back, there is no question that these policies were instrumental in getting the recovery going after the GFC in extremely challenging conditions. But there is also a growing sense that the impact on activity diminishes at the margin, both in terms of the intensity and the duration of the use of these measures. In terms of intensity, and without going into details, let me just mention a few examples. There are limits to how far credit spreads can be compressed, how far firms may care about borrowing costs, which are just a few basis points when deciding on their investment. There are limits to how far net interest margins can be reduced without reducing the lending capacity of banks, because you would be reducing profits and therefore their ability to generate capital. There are limits to how far agents can borrow from the future as opposed to start saving for retirement. There are limits to the extent to which emerging market economies can reduce interest rates without triggering disorderly capital outflows, which would be contractionary. And of course, there are limits to the extent to which you can cut interest rates or induce depreciation of the currency before other countries basically respond. Now, in terms of duration, just think of the impact on bank profits. In the short run, it's positive because you're boosting asset prices, but longer term, you're left with the impact on net interest margins. Now, importantly, most of the empirical evidence that we have available is not really looking directly at the question of the impact of these measures on economic activity, partly because there is little data. What it does is look at the impact on financial conditions, but then it tends to assume that the impact that we saw in the past holds, which obviously is not providing the answer to the question that you would like to have. Now, some work that we have been doing at the BIS, and I've seen some similar work outside, which is trying to test this element directly, this link directly, does find some evidence of diminishing return. Now, what about the costs? Now, there is a consensus, not least within the central banking community, that while effective, these measures have limitations, have side effects. And again, without going into detail, let me mention 4 over which there is consensus. One is that unusually easy financial conditions can spur excessive, and I underline the word excessive, risk-taking. No doubt, some of the vulnerabilities that were there before the COVID-19 crisis were the result, in part, of the unusually accommodative monetary policy that was there for so many years. Second, such conditions can sap the resilience of financial intermediaries. I talked about banks, but that is also true for insurance companies and pension funds. Third, they may encourage the misallocation of resources in the form, if you like, think of a weakening or a softening of budget constraints in general. And finally, and this was mentioned before, they can raise tricky political economy issues, not least with respect to for the relationship between central banks and governments, raising the risk of fiscal dominance and, of course, of the loss of autonomy. And I think that Don talked about that. Now, in the case of the cost, I think that duration is probably even more important than the level, because the benefits, the impact on economic activity in the short run is visible. But the costs take a long time to develop and to materialize. It takes time for debt to build up. It takes time for the vulnerabilities to build up. So this can give rise to an intertemporal trade-off, which is quite tricky to deal with. Now, the real debate is not whether the costs exist, but in terms of their size, in terms of how long it takes for them to materialize, and finally, how far they can be effectively addressed through other means, for example, prudential regulation and supervision, in particular macroprudential regulation and supervision. So let me finish with 2 implications. First, ultimately, I think there is a possibility of a debt trap. What do I mean by that? Let me just go through the logic. Inflation, for structural reasons, remains insensitive to stimulus. We know that the Phillips curve is very flat and indeed hard to pin down. And to my mind, this is likely the result of to a considerable extent to structural forces such as globalization, technology, which have put down persistent downward pressure on prices, and in particular, which have sapped the pricing power of both labor and firms, making the second round effects of the past, particularly during the great inflation era, much less likely or at least more muted. Moreover, there is evidence that inflation expectations tend to be backward-looking. Agents, and I'm here not talking about financial markets, I'm talking about firms, I'm talking about households, I'm talking about labor, workers. They're influenced more by outcomes than they are by announcements. So under those conditions, one would expect interest rates to remain low for longer. And that would therefore tend to encouraging to build up the debt that I talked about, and also some of the financial vulnerabilities, so that it would make it more difficult for central banks to raise interest rates when they would like to raise interest rates without damaging the economy. So you see here, there is a kind of self-fulfilling mechanism that I think we should monitor closely. The second implication follows from the first, is that, to me, the challenge of the decade ahead will be to rebuild policy buffers. I'm talking about in the monetary sphere, but I think this is also true in the fiscal, will be true in the fiscal as well as in the prudential sphere. There is no question that the broad and forceful necessary response to the crisis that has been so successful has further reduced the room for policy maneuver. And an economy with small safety margins is exposed and vulnerable. That's why in other domains, policies tend to build in a safety margin. Think of energy, think of transport, and think indeed of the health service. Now, let me be absolutely clear, and this is important. Withdrawing policy accommodation, which would be the first step towards rebuilding buffers, is not for today, it's not for tomorrow, or even for the day after tomorrow. The economy will require support for quite some time. Moreover, there is a natural concern that even talking about withdrawal of accommodation could reduce policy effectiveness by reducing confidence. But at some point, and as soon as conditions allow, disengagement will be called for. And so starting the debate now, I think, can get markets and economic agents in general better prepared for that point in time. Now, at that point, rebuilding policy buffers will be a challenge. And one of the key ingredients to me to facilitate that process would be flexibility in the pursuit of inflation objectives. Now, I don't think we should underestimate the importance of this task, because if something is valuable, it must be worth paying a certain price for it. Thank you very much.
Thank you very much for those comments. I agree with you very much that one really does not want to have premature withdrawal of policy support, that we're far too early in that. But is the issue not that we need to get a better balance between monetary and fiscal policy, that too much of the burden has been placed on fiscal policy? It's encouraging excessive risk-taking, it's encouraging credit misallocation, and all that we're doing is that we might be getting a short-term economic recovery, but at the cost of perhaps building bubbles that'll burst later on and will be very difficult to deal with.
Now, I mean, the whole world is not that. It's not the U.S. Clearly, in the United States, you have had difficulties increasing expenditures and having fiscal policy taking a big role until recently, for example, with the second package. Now, in the rest of the world, I mean, fiscal policy has been very active, and there has been no issue about it being very active, including in emerging market economies, by the way, which of course raises issues further down the road, but it has been quite active there as well. And given also the nature of the crisis, I think everyone agrees that fiscal policy is much more effective than monetary policy in dealing with the underlying problems. So yes, fiscal policy has to play a bigger role. It has played a bigger role in many countries. And this is also true going forward to the extent that the economy may need further support. But I would not take too much comfort from the fact that interest rates are below growth rates to get a sense that, there is no limit to what fiscal policy should do.
Right. I thought that there was a real problem in Europe, in that a number of countries, particularly in Southern Europe, are suffering very deep recessions. Their public finances are totally distorted, running very big budget deficits. I'm thinking of places like Italy. That must certainly pose a very big challenge, to the ECB. That how long can the ECB keep that show going?
But I mean, that, if anything, suggests that fiscal policy has been too lax for too long in those countries. It's not that it has been too conservative. It has played too much of a role there. But this is for structural reasons that have to do with the politics of the situation. Yes, indeed. I mean, not all countries have the same room for maneuver. And some countries, for example, they don't issue their own currency. And that means that the constraints bite earlier than elsewhere. And in Europe, that's one example, because we have one single central bank for what is an area of multiple jurisdictions. And in emerging market economies, that's also true, because they borrow quite a lot in foreign currency. And I'm sure that Steve knows this very well, given his experience at the Fed. But again, the point I'm making is that clearly, surely there is a role for fiscal policy, and fiscal policy has to take some of the burden off the shoulders of monetary policy, and we have said that in the past, even before the COVID crisis. But the only thing that I would like to say is that one should not go to the other extreme, which is what some people might think, which is that there is no budget constraint because interest rates now are lower than growth rates.
Yeah, I couldn't agree with you more than that. I think that there are a lot of people who seem to think that because you've got low interest rates and that you might have growth a little bit above the interest rate, there's not a debt problem. When I look at some of these countries running budget deficits like 10, 12% of GDP, primary budget deficits very high, even in a world of low interest rates, you can have a debt problem. I don't think there's enough discussion of that issue. But let me turn it over now to thank you for those remarks, and let me turn it over to Adam for his perspective.
Thank you, Desmond. Thanks to you and Steve Kamin and AEI for having me today with these very distinguished folks. As presumably you intended, I'm going to be on a slightly different tack than the previous set of comments, and where you and Claudio particularly agree. Not wholly, but meaningfully, I think. I mean, basically, I've always hated the image of ammo talking about central banks. In addition to everything else, it goes with toxic masculinity and machismo. And, if you look at this panel, which is sadly typical of who are central bankers, we're not exactly Rambo types running around. So let's get rid of the ammo idea. The central bankers have different tools for different jobs. And it turns out that the toolkit is really effective at dealing with short-term liquidity problems and panics. That's what we saw in March, April of this year. That's what we saw in 2008, 2009. You can really do a great job of stopping the bottom from falling out and responding to seizing up markets. Then you can get into, should the markets have seized up? Are there other things you can do to preempt that? That's all important. But the ammo to do that, again, I shouldn't even use the term ammo. The tool to do that is almost unlimited and extremely effective. And there are better and worse ways of doing it. And so the fact that we had the central banks under Fed leadership doing the swap lines we saw do so well in coordination in the spring of earlier this year, makes it better. There are better and worse ways to do it. But broadly, if it's a short-term financial shock, if it's a deflationary shock, if it's a panic, central banks can take care of it. The flip side is if you have something that is a lasting burden on people's expectations and confidence, or is a real economic shock, there is very little the central bank can do. And so when one thinks about looking at the last 12 years, one finds that central banks have been repeatedly pushing on a string, as Keynes would have it. Or pick another old saw. You're leading the investors to water, but you can't make them drink. For all the talk about bubbles, the whole point and the whole problem has been that low interest rates and QE do not lead to runaway recoveries do not lead to large amounts of business fixed investment. For all the talk about bubbles, the issue is more one, as Don Kohn rightly cited Larry Summers, of secular stagnation. And here I am perhaps overly influenced by my experience working on and getting to know what happened in Japan, starting in 1989-90. But the issue has been that when things start going wrong financially, or when things start going wrong in terms of overt deflation, the Bank of Japan has been effective. But even if the Bank of Japan does everything that was on the wish list, the Don or his colleague at Brookings, Ben Bernanke, or his former colleague, now Treasury nominee Janet Yellen, said on the record the Bank of Japan should do, it was helpful, but it didn't create a self-sustaining recovery and it didn't create inflation. And we're now seeing that repeated in Europe and the US. And so you can say, well, you know, this was a special case and inflation's around the corner and all this. And that may well be true. It may well be, just as we used to talk about, you know, the coming to recessions as a switching between regimes. You switch from the high growth regime to the low growth regime. That's fine. It may be that we could switch back into the high growth, high inflation regime, but we have to take seriously the regime we're in. And the regime we're in is one where central banks, in my view, are basically asymmetric in their monetary policy powers. They're very good at playing defense and not very good at playing offense. They can prevent things from getting out of control, and they're not very good at putting points on the board. And another way of putting it, which I feel necessary to raise at AEI because of your intro, Desmond, is the issue of balance sheet size. And if we want, I know you're much more sophisticated than this. I'm not trying to characterize your views, but I mean, if we want to be very simple-minded about this, right, and go back to Milton Friedman, MV equals PQ, essentially we're in a situation where velocity, is doing all the explanatory work. And it's empirically, it's a residual. And so, as I said in my first speech as a member of the Bank of England Monetary Policy Committee in October 2009, don't pay attention to the size of the central bank balance sheet size. It's not useful information. Don't be a mechanistic monetarist. I said that 11, 12 years ago, and it turns out to, I think, hold up pretty well. And again, we may revert back to some other era, if we're lucky, where that turns out to be the case. But we shouldn't be focusing obsessively on these things that have had little or no relevance for the past more than a decade, and for the last couple decades in Japan. And so when we go forward and we talk about our you know, what are the imbalances and what's the relationship to fiscal policy, here I'm much closer to what Don and Claudio and you, Desmond, have said. I mean, we all agree it would be great to get fiscal policy more active. And it's one of these things about public life, I mean, not public life, but the kind of public policy discussion we all engage in, I don't presume to be known to the general public, is that no matter how much people talk about, oh my God, fiscal policy is going to get out of hand, we always are pulling teeth just to get the stimulus. The only exception, thank God, was the stimulus packages of the second quarter of this year, in the face of an enormous pandemic with an obvious short-term shock. But here we are again, the US took a long time to get back to a second stimulus. In Europe, we have Hans Werner Sinn and others populating the FAZ and the other leading German press, warning about the inflation fear and the state debt quotient in Germany's gone up too much. In Japan, if you look at the data closely, until you get Abe, you do not get genuine public investment or much public expansion controlling for the business cycle. And so this constant refrain that we're going to overdo it on fiscal policy, and that, oh, what my colleague at Peterson, Olivier Blanchard, has set out about the much lower risks or the much broader range over which debt is sustainable for large economies and democracies, that's not our problem. That's not our problem. We're not seeing the sustained public investment that would be the logical result of the interest rates we have and the situation we find ourselves in, let alone climate change and inequality. And so then when we get back to issues of the financial stability spillovers, which Don has been wrestling with as a member of the Bank of England FPC, and which Claudio and his colleagues at the BIS have done so much influential work on, I again have a slightly different view, because in the end, people have to stick their savings somewhere, right? And people spent years saying the US population has to increase its household savings rate. Well, increase its household savings rate roughly 1.5% of GDP following the global financial crisis. It's now shot up enormously. It's going to come down, but likely will on net remain up another percent or two. And they got to stick the money somewhere. And for all the talk of bubbles, people aren't going out and doing that many things with the money. And so what you really need is to issue an awful lot of public debt to suck up those savings. And there are a lot of better things we could be doing with their savings right now than what we're doing. And so I think that that's where the action has to move to. It's not about fiscal monetary coordination being complicated or difficult and needing very contingent, difficult, complex regimes. It's about the much more politically difficult situation of having to justify in our dysfunctional legislatures in the US and throughout the rich world what's a good investment and what's not for the public sector. And that's not going to be determined by some golden rule, and we have to just fight it. But so my bet is that we're going to be doing insufficient fiscal policy for an extended period, because there will be insufficient agreement on what constitutes constructive public investment, even though rates are so low that hurdle rates basically should be very low. And even though we have obvious things to spend it on, as Don rightly referred to, some hopeful signs on clean energy. And so this ultimately, to go back to something you raised at the start, Desmond, is why I'm an advocate of yield curve control for the Fed or for the ECB if they have enough of a safe asset to do it on, like the Bank of Japan, because it's a way of depoliticizing the central bank's engagement with the fiscal process. It says we're not judging the fiscal process by the content of the fiscal policy, which is not our business. We're just stabilizing the rate until the macro conditions change. And I think it's a relatively clean and simple and communicable way to go. And we've seen it work in Japan, and we saw it not do anything terrible to real economic performance during the Treasury Fed Accord of the 30s to the 50s. Now, obviously, some of that was wartime, and that was part of the motivation, and I'm not denying that. But in the recovery after World War II, the Treasury Accord was not a problem either. So that's where I would come out. And so I think central banks running out of road, it depends what road you're on. If it's about financial stability and preventing sharp downturns, no, central banks can still do it. If it's about creating self-sustained recovery, no, they can't do that. And if there are dangers from imbalances, they're there, and we can deal with them by regulatory means. But best of all, would be great if we could create some more public investment that could suck up the savings that currently are running around. Thank you.
Thank you, Adam. Just if I might ask, when you say that there's not a creation of bubbles, if one looks at the equity valuations right now, we're seeing equity valuations that we haven't seen, in the last, since 1929. We're talking about really very high equity valuations that, as Claudio would say, there's daylight between the equity valuations and what's really happening in terms of the real economy. And what I also thought is we're seeing countries that have got very compromised public finances being able to borrow huge amounts of money. I'm thinking of places like the Brazils and the South Africas of the world, that what we're doing is we're really getting credit misallocation on a big scale that just seems to be setting us up for what Carmen Reinhardt seems to think we're going to have is a emerging market debt crisis that's going to make anything that preceded it look pale. Are those not some things that we should really be worried about, in not having the right balance? That what we're doing is we're feeding bubbles in the equity and credit market and other asset markets that really puts in danger of getting a repeat of what we saw in 2008, 2009. Sorry, I can't hear you.
Sorry. No. First point is, as we've already seen, the banking system has benefited from the capital and liquidity requirements and the greater oversight and regulation that were put in place since the global financial crisis. And they've been much less leveraged and are much more stable throughout this period. Second, what you define, Desmond, isn't a mechanism to explain what's happening in emerging markets or developing countries for that matter. We've had plenty of cycles in which either the Fed tightening has led to extreme tightening on the other side, or when the Fed doesn't tighten, people decide to move money out. We saw that earlier this year. There's nothing forcing people to keep their money in emerging markets. If it's truly just an inflation play, they can go to Bitcoin, they can go to gold, they can go to timber, they can go to Norway, they can go to Switzerland. So it's not anything created by the Federal Reserve. And again, what you're insisting on is something that must be regulatorily addressed, because ultimately what you're saying is people are choosing to take risks that make no sense on a sustained basis. So why would you do that? Why would you buy an Argentine 100-year bond? Well, it may be because you're a money manager and the incentives for how you're overseen in running that fund are wrong. It may be because there's regulations about endowments and insurance companies and pension funds about them on paper having to make a certain return, which we know is just not possible in the current environment, in which case the issue is not the rate of return on the Federal Reserve short interest rate. The issue is a regulation that has a fixed return in the legislation or an unrealistic return in the legislation. So I just don't see the causal link that you're positing.
Okay, I guess what I'm concerned about is I'm concerned about the problem. I'm concerned when I see these bubbles forming, and the prospect that we're getting countries building up huge amounts of debt that they're likely to default on. And I would also think that while you might have the banks better supervised since 2008, you've got the whole non-bank financial sector, all of these hedge funds, equity funds, all the like, which can cause us a lot of trouble, as we learned, from LTCM.
Well, what we saw from LTCM was actually it didn't cause us a lot of trouble. And what we saw repeatedly in 2008 to 10 was a bunch of hedge funds blew up and they didn't cause us a lot of trouble. What did cause us a lot of trouble were AIG financial products and a bunch of systemically important institutions. I don't fully buy the asset manager's argument that they shouldn't be regulated, but they should be regulated more than they are. But I do buy the fundamental reality that non-bank financial institutions, if they get into trouble, are less dangerous because they're not government guaranteed, because they're not illiquid in the same sense, because they don't serve the same function as banks. So I don't dismiss the risks you're talking about, but I do think they are materially less. And it was not all, people sometimes say the increase in regulation after 2008 or after 2012, more accurately, pushed risk out of the banking system. That's true. That's not entirely bad. Pushing some of the risk out of the banking system diminishes the systemic risk. But I still don't, Desmond, you're the expert on emerging market capital flows and I'm not. So I don't want to take up time that Steve can talk about this much better than I. But I still don't get the fundamental point, which is no one is forced to buy Argentine 100-year bonds. No one is forced to buy uncollateralized public sector debt of governments that are not dependable. And so the question comes, so you say, well, what's going to happen? Well, what do you want to have happen? So who's the regulator who says you can't hold that? Well, that would have to be somebody in London or New York or Washington or wherever, where the cross-border savings are, saying you're not allowed to invest in that. It's not a monetary issue, to my mind.
Okay, thank you. That's a good segue into Steve. Steve, the floor is yours, and you feel free to comment on what Adam has just said.
Thank you, Desmond. Maybe we can leave that for a little later. I just want to, first of all, for start, say what a pleasure it is and an honor to be, sharing this virtual podium with such distinguished experts. And as I feared, when you come last after such a group of distinguished experts, they've said everything that is wise and germane. So all that they've left me to say are things that are either irrelevant or objectively wrong. But let me proceed. Actually, I'll start with something that I think is correct and that Adam actually also started with, which is that whatever the ability is of central banks to boost aggregate demand and achieve their mandates over the longer term, they quite obviously retain the scope to stabilize turbulent financial markets, maintain the flow of credit to businesses and households, and provide critical support to the economy in times of crisis. So through rate cuts, QE, and a whole bunch of special credit facilities, they certainly proved this in 2008, and they proved it again this year. And as a result, they've moderated recessions that might otherwise have turned into depressions. So whatever the future brings, unless Secretary Mnuchin and Senator Toomey have any additional tricks up their sleeves, central banks are going to continue to play a critical role in stabilizing financial markets. And that's going to be an essential aspect of countercyclical policy. But I share the concerns of my fellow panelists that once the financial markets have calmed down and credit markets have revived, that monetary policy is probably not going to be able to play the same role in boosting demand that it has in the past. And so this reduced scope for monetary policy partly reflects the constraints imposed by the effective lower bound for nominal interest rates in a world of declining real equilibrium interest rates, or R star. So accordingly, many economists believe that you can restore the efficacy of monetary policy by unlocking the lower bound problem, which you can do either by pushing nominal interest rates into policy rates into negative territory, or using QE or forward guidance to push longer yields down, or by raising the inflation target so that nominal rates can start from a higher point and then the central banks can push them down from there. So those policies are all premised on the assumption that while the equilibrium real interest rate, R star, has declined over time, that the relationship between changes in interest rates and changes in economic behavior has remained unchanged. And so accordingly, if you can just find a way to push those interest rates down further, you can restore potency to monetary policy. And it's therefore not surprising that the models that are being used to evaluate these policies, which assume an unchanged structure of the economy, generally find them to be effective. And what I have in mind here is Ben Bernanke's excellent AEA speech at the beginning of this year, where he evaluated different approaches toward dealing with monetary policy, as well as a lot of the staff papers that accompanied the Fed's rollout of its new monetary policy framework back in August. But what if the problem is not that central banks can't push down interest rates, but that even when they do so, it generates less boost to demand and with greater risks to the economy and the financial system than was the case in the past? And this is the argument that Jason Furman and Larry Summers made in their great presentation at the Peterson Institute that we've already talked about a few weeks ago. And like Adam, I'm partial to the secular stagnation view. And so what I'd like to do here is to flesh out an important but underappreciated aspect of that, which is the role of business investment in the transmission of monetary policy. Now, Claudio has already heard my rant on this, and so I apologize to him, but the rest of you are just going to have to suffer. With that, what I'm going to attempt to do, and what passes for heroism in the age of Zoom, is to try to share my screen. And voila. And now all I want to do is wait until I can start the slideshow. Okay, so now you can look at this while I talk. So in textbook models, companies borrow to invest, and lower interest rates reduce the cost and increase the availability of funding. So accordingly, monetary expansion generates, greater capital expenditures. But as you can see in this figure, for most of the post-war period, corporate investment, and that's the red line, exceeded corporate saving, which is another name for profits. That's the blue line, okay? And so corporations borrowed the difference, which is shown by the gray bars below, as negative values for net lending of the corporate sector in order to complete their financing of their investments. But since the start of the 2000s, as you can see, corporate profits in the US have risen above business investment spending. And that's a phenomenon that's often referred to as the corporate saving glut. So in consequence, instead of borrowing from the rest of the economy, corporations started lending to the rest of the economy. And as you can see here, similar developments have actually been occurring, and perhaps to an even greater extent, in other advanced economies, as indicated by the blue net lending area from negative to positive. So the emergence of the corporate saving glut has likely had two important implications for monetary policy. First, with the corporations either hoarding their accumulated earnings or returning them to shareholders through dividends and buybacks, the corporate saving glut is probably subtracted from aggregate demand and added to downward pressures on R star. So this figure here basically compares an estimate based on the Lawbuck and Williams methodology of R star, that's the black line, compares it to corporate net borrowing, which is just the corporate net lending I mentioned before, but with a negative sign, okay? So obviously, the evolution of net borrowing can't explain all of the long-term downward trend in R star that you see in this chart. However, if you look at these two regression equations, okay, these are just simple OLS regressions of R star. In the first equation, it's regressed on the net borrowing that I just showed you, as well as a time trend, okay? And obviously the time trend is super significant as indicated by the 3 stars. But interestingly, the net borrowing is also statistically significant, indicating that declines in net borrowing or increases in net lending basically should reduce R star. Then looking at equation 2, we actually break up that net borrowing into its 2 component parts, gross investment and gross saving. And both of these are also statistically significant, suggesting that that kind of relationship that we're seeing between net borrowing and R star, is not just about movements in investment. It's about movements in corporate profits as well. And so all this is at least suggestive evidence that there is indeed a connection between the decline in R star and the emergence of this corporate saving glut. All right, now a second implication of the corporate saving glut, which might be even more important for monetary policy, is that because cash-rich corporations are less dependent on external funding, the glut has likely diminished the effect of interest rates on business investment. So it's changed the elasticity. So this table, I hope that's not me. This table here is basically drawn from a survey of corporate CFOs that's been analyzed by my ex-colleagues at the Federal Reserve, Steve Sharp and Gustavo Suarez. And the CFOs were asked the question, how much would borrowing costs have to decline to induce your firm to boost spending next year? And so as you can see, it turns out that only 21% of the firms surveyed would change their plans, in other words, increase investment, in response to declines in borrowing costs of 3 percentage points or less. And 68% wouldn't change their plans at all. Now, to be sure, it's well understood that business investment's not all that responsive to interest rates. That's been known. But it's probably become, that insensitivity, I think, has probably become even more marked in recent decades. So in this table, part of this, drawn from the same paper, the CFO were asked, well, if you're not going to change your investment, why not? Okay. And as you can see here, the leading explanations were first, that funding was already ample, whether from cash flows or cash stocks. And secondly, that interest rates were already very low. And indeed, as is very well known, and as you can see in this chart here, corporate financial assets have soared in recent years. In fact, the 2017 Trump corporate tax cut may have actually further reduced the efficacy of monetary policy by making firms even more cash rich. Now, of course, smaller, newer, and less moneyed firms might still take advantage of lower rates and higher equity prices associated with monetary stimulus, but the larger and established firms probably not so much. I'm going to stop sharing at this point. Okay, so all this is to suggest that the importance of business investment as a channel of monetary policy transmission has probably further diminished. And this is unfortunate, since when monetary stimulus boosts investment, that adds to the economy's future productive capacity, whereas other channels of monetary transmission, which are now going to have to do more of the heavy lifting of stimulus, are less felicitous. So to be clear, I'm generally okay with stimulating housing investment, which is, of course, a very important interest-sensitive sector, as long as that housing investment isn't overdone. But encouraging household spending merely shifts consumption from the future to the present, which is a dubious business benefit for millions of Americans that are already on track to miss their retirement goals. And as Adam kind of like, or either Adam or maybe Claudio, I think it's Claudio mentioned, encouraging exchange rate depreciation through monetary stimulus basically only shifts consumption around in the world and probably invites similar actions on the part of our trading partner. So it doesn't really help much. So on top, of course, of the reduced efficacy of monetary policy stimulus these days, there are also lots of standard financial stability risks. And Claudio hit most of those, but I'll just recount, excessive asset price inflation, encouragement of reach for yield behavior, damage to insurance companies and pension funds, reduced profits for banks, and maybe even preservation of so-called zombie firms. And I think that all of those concerns are probably more acute, in a world of very low and prolonged interest rates like we may be facing. So with the benefit of monetary stimulus reduced and the risks enhanced, what does that mean for the conduct of macro policy? Well, first of all, as my fellow panelists have highlighted, we probably need more fiscal stimulus. But at the same time, central banks are going to have to become more judicious in their application of monetary stimulus. On the one hand, a lesson the central banks have already learned very well is going to be all the more salient, which is that monetary policy is going to have to respond swiftly and substantially to any adverse shocks that threaten to disrupt financial markets and economic activity, because once the economy falls into recession, it'll be a lot harder to get out of it. But on the other hand, if you have cases of prolonged economic weakness, then central banks may need to desist from doubling down on their accommodation, because the benefits of doing so may well be exceeded by the costs. And I would think this lesson would apply especially to cases where the economy is doing pretty well, the labor markets are already tight, but inflation lingers below the central bank's target. So I will stop there and return the microphone to Desmond.
Thanks a lot, Steve. Perhaps what I can do now is just ask you a couple of questions and then perhaps let the other panelists give their comments on what you might answer. I guess what you're saying is that the monetary policy no longer is going to be effective through corporate borrowing. My question is, at zero interest rates that we're now at, we're pretty much at the lower bound. How do you find monetary policy works? Through what channel? What is the main channel? If you can't reduce interest rates lower, is it that what we're doing is we're promoting asset price increases, that we're getting people to take on more risk? Is that really the way in which monetary policy works? And if so, I come back to my earlier question to Adam, are we not setting ourselves up for problems down the road through distorting credit markets through that process? That's the one question. The second question is, we've said nothing about deflation. I'm just wondering if you see that as much of a problem, looking at Japan, looking at Germany, thinking that you've really got, looking at Europe and Japan, that we're going to have very large gaps in labor and product markets for a while. Could that be another factor that makes monetary policy less effective, that we're getting into some kind of deflationary problems?
Sure. Well, let me take those into. Well, let me start with the first question first. How is monetary policy actually working right now? Well, first of all, as I and others mentioned earlier, it's working by not only having in March and April having restored financial market functioning, but it's working by continuing to do that. In other words, in the absence of strenuous monetary accommodation, you could imagine that in response to recent shocks we've had, like the resurgence of the pandemic and the earlier concerns whether there would be any stimulus problem at all, package at all, you could have imagined the financial markets would have gotten back again into a turbulent phase, and that did not happen. So that's critical. Second factor is undoubtedly by promoting increases in stock prices and reductions in credit spreads. That may have increased some investment, but I'm a little skeptical of that. But it has certainly helped. Probably helped some consumption at the margin. So higher equity prices have helped. Another factor is that by keeping interest rates super low and keeping credit flowing, a lot of firms that would have gone bankrupt in a tighter financial environment, are still alive, and that's been an economic support. And finally, and this is perhaps the most tangible thing, super low interest rates have dovetailed with some interest by a lot of renters in buying houses to promote a pretty vibrant housing market, in this otherwise depressed situation. So those are all factors I think that are at play here. And my concerns and some of our panelists' concerns are just that, if we're in a low inflation environment for more years to come, how important will those be? And can you get inflation up to target as a result? On your second point about worries about deflation, that's obviously a prominent concern. And it's one that has motivated a lot of monetary accommodation by the BOJ, ECB, and also in a more anticipatory way by the Fed. I would have to say that I'm a little bit less worried about deflation as a result of the Japanese experience of the last 20 years than I might otherwise have been, in the sense that in Japan, we did not see that spiral of declining inflation, leading to declining inflation expectations, leading to higher real interest rates, leading to further declines in inflation. Now, what happened instead, we had like 20 years of like low inflation or mildly negative inflation. So I wonder whether that part of the worry is up for reexamination. I'll stop there.
Don, would you like to add anything?
Thank you, Desmond. Just a couple of comments. One of my takeaways from Steve's presentation was I thought it reinforced some of the points Adam was making. So there are excess savings around. We don't really need weak business investment for reasons we don't fully understand has kind of gone hand in hand with a downshift in productivity growth, right? Around the middle of the 2000s, early middle 2000s. We don't totally understand it, but it does suggest, particularly as Adam pointed out, if there's more household savings, and I agree with him, we had an uptick after the global financial crisis. We're more likely than not to have another little uptick after this. The crowding out issue with fiscal policy and the pressures on interest rates, at least for a while now, till we get back to full employment, are likely to be quite muted. Something's got to soak up all those savings. And I thought Steve helped reinforce Adam's point in that regard. The second point I'd make, though, is really in response to you, Desmond. So you keep talking about bubbles as if they're self-evident, and distortions. And I guess to me, the judgment about bubbles and distortions and overborrowing is entirely dependent on what you think is going to happen to interest rates. So if interest rates are going to stay very low for a very long time, you're going to have higher price earnings ratios. The present discounted value of future earnings is going to be much higher at low discount rates. So I don't, and home prices will be higher. Everything will be, all these asset prices should be higher if interest rates are going to stay low for a very long time. And I think and I can't speak to the emerging markets, and I know you've worried about Italy for a very long time, Desmond. Can't speak to that, but I think if I look at the US, Northern Europe, UK, the equity premiums relative to these low rates don't look that stretched. Now, I think the risk, as I tried to point out, is that if everyone's expectations that interest rates are going to be low for a very long time because there'll never, ever be any inflation, because Desmond's right, the bigger risk is deflation than inflation. If people are wrong about that, there's going to be quite an adjustment that's going to take place, and that's going to be an issue. But I think with low interest rates, debt service ratios, actually, the business credit is huge and business debt is huge, the cost of servicing that debt is extremely low. The cost of servicing government debt is extremely low. So if there's a bubble, the bubble is people are wrong about the persistence of low interest rates over time. I think that's probably a pretty good bet, but there's a tail risk out there that it might not be, and that's the tail I'm worried about a couple of years down the road.
I guess, what my concern is not that interest rates on United States treasuries or real risk-free assets will stay very low. It's really on the risk product, that I could see the interest rates there rising, as the default risk rises. And, you mentioned Italy, what I'm struggling to get my head around is how can a country whose debt situation has materially worsened, we've gone up from something like 130% of GDP to 160% of GDP in a year. We've got a deficit that's now 10% of GDP for as far as the eye can see under a fixed exchange rate system. They're going to have an awful trouble getting that deficit down. Yet, despite all of that, the interest rate at which they're borrowing goes to zero. So I really find it difficult to see how you get that. If that is not an indication that there's some kind of something going wrong in credit allocation, and I can tell you the same story with Brazil or with South Africa, or with, any of these other countries that their fiscal situation looks totally shot, that they're clearly on unsustainable debt paths, yet they're managing to borrow at ridiculously low interest rates. I'm not sure that that's a stable situation, and I'm worried what happens, when that begins to unwind. I don't know if you want to say something, otherwise I'll go to Claudio.
Why don't you go to Claudio?
Claudio. Claudio, you're on mute, Claudio.
And I'm blind.
Claudio, you're on mute. Maybe Adam, would you like to weigh in?
Well, Claudio, just to say first off that, Claudio's back. I defer to Claudio.
Yeah, I'm back. And for some reason, whenever I touch the mouse, it just disappears. I mean, I had this problem before the actual event, and I don't seem to be able to deal with it, regardless of how careful I am touching it. So let me just make 2 points, one narrow and the other broad. The narrow point is, are we seeing markets overstretched, yes or no? I think it's always very difficult to try and work out whether markets are overstretched, particularly when it comes to equities, because we don't see the future income stream. Now, I think on the other hand, it's somewhat easier if one is looking at credit spreads. And in the case of credit spreads, which are almost on the very low side historically, I think that if you were to be told that we're going through this COVID crisis, that there could be a wave of insolvencies coming down the road, And if people told you that credit spreads are at the low end of the historical spectrum, I mean, I think you would be surprised, and I think you would be justified to be surprised. So that's one, but that's a rather narrow point. And also that also applies to sovereign credit spreads, if you look around the world. So that's the first point. The second point has to do with this, with what Kohn was saying. Don was basically saying, well, you know, if interest rates remain very, very low for very, very long, then everything is fine. Everything is fine because all these valuations are justified. I am really concerned. I'm really concerned about circularity here. I mean, we seem to be talking about this interest rates coming down from heaven, just being there and adjusting to them. But you can see how those very rates are creating a world which is more fragile and more intolerant of higher rates. And I think that the risk is that we might find it much harder to raise rates simply because the world will be much more fragile. Financial markets will be more fragile. The economy is going to be more fragile. Debt service ratios are key. Is one factor which is key in driving the economy. All empirical evidence suggests that. So if you were to raise them at some point, you could face difficulties. And I think this aspect is, I don't think we paid sufficient attention to. So we may be creating those conditions that are going to be difficult to raise rates. And I don't think, and this I'm with Steve, I don't think that one should wait for inflation to necessarily be a big problem before interest rates are raised. I think that when I was talking about building buffers, my suggestion is that you would like to have some buffers to be able to respond to a future recession. And that means that as the opportunities arise, you would like to raise interest rates when the economy is strong, when the economy is projected to grow way beyond potential. I mean, inflation is not the only, we saw it before the GFC, but we've seen it historically across a whole range of countries. Inflation is not a sufficient statistic for macroeconomic stability, for sustained macroeconomic stability.
Adam, thank you, Claudio. Adam, would you like to come in?
Well, just first thing, thank you to Steve. Don kindly put it as he reinforced my points. He actually brought a new dimension and did it better than I did about the corporate lending or just saving. And I think that's a very important part of the picture. Second, I really, maybe this sounds stupid, especially because we have people on this panel who did spend decades in leadership roles in central banks. I would really like the time frame of our discussion to get shorter. I realize that for how we evaluate policy. I realize that the standard trope of technocratic economists for more than 50 years has been that we're too short-sighted and politicians are too short-sighted and we're too emphasizing the short term and we need institutions that insulate us from the short term and on and on and on. And there is a legitimate case to be made for insufficient concern about future generations. But right now, for the umpteenth time in recent decades, we are being insufficiently aggressive on inequality, insufficiently aggressive on climate change, above all, insufficiently aggressive on global poverty interacting with the pandemic, and insufficiently, I don't know what the right word is, arrogant, wishful, hopeful, overconfident, that policy regimes we pick for this time period should last more than 10 years. And Don was kind enough to cite the work that Bernanke, Michigan, Laubach, and I did, among others, on inflation targeting. I always viewed, I'm not speaking for my co-authors, but I always viewed inflation targeting as a specific response to specific pressures in the 90s, and that was an incremental improvement on other previous two discretionary regimes. I didn't view it as an ultimate regime that should last forever. And so I guess this is where I would just like us to be more working the problem and thinking less about regimes. If we get, and Blanchard has written about this in a more sophisticated way than I can put it, if we are so lucky as to have an increase in private investment demand and other factors that make it so that interest rates rise, we can deal with
it. Desmond, could I comment, not so much on what Adam just said, but on the previous conversation?
Surely.
So I think I don't want to leave the impression that I'm not worried about financial fragility. I am. And I think we need to work very hard on the non-bank sector. I think we need to fine-tune the banking regulation for various things. But I think what we saw in March was new fragility or fragilities, unexpected fragilities in the in market finance, including in the treasury securities market, for crying out loud. So the foundational market for the global economy, the global financial markets, had a glitch. So I think I don't know, Claudio, whether the IS curve has gotten much flatter and we'll have a very sharp decline in income next time we try to raise rates, whether the system is more brittle. But I do think we need to work on the potential sources of fragility and brittleness, not through monetary policy, not through taking back the easing, but through regulatory policies, particularly focused on markets and the markets that got in trouble. So I am concerned about those fragilities, and we do need to work on them through supervisory regulatory policies.
So just to clarify, because I think in some respects don't work closer than you think. But first of all, there have been fragilities shown, revealed by the COVID crisis. And again, particularly in the United States, but not only in the United States, but particularly in the United States, those fragilities showed up for the second time in a decade, actually, in the non-bank financial sector. And those fragilities have to be addressed. And indeed, there is a lot of work going on in the international bodies, in particular under the aegis of the FSB, which is looking into this. So that we know. I don't think that central banks can come to the rescue of these markets every time they risk collapsing and imploding and generating problems for the financial system. I also would like to underline that, which didn't come up in the discussion, but central banks have been part of the solution as opposed to being part of the problem in the current crisis, as a result of the fact that regulation indeed pushed them to have much higher capital than they originally had. Now, the points that I was making, though, had not really got to do narrowly with financial stability per se. You know, what's going to happen to the banks, what's going to happen to the non-banks. I was just talking about a macroeconomic issue. And that is a macroeconomic issue that higher debt, regardless of whether we're talking about booms or I'm not talking about booms that are getting out of hand, which is basically what happened before the great financial crisis. Higher debt simply makes economies more vulnerable. Asset prices that are highly dependent on very, very low interest rates makes economies more vulnerable. And we also need to think about, you know, what is the policy mix. And again, I'm not talking about the United States. I very often when I'm on these panels, particularly in the US, it looks as if the whole world is like the US. And I think that's a bit of a problem, particularly for people like me who don't want to talk about specific countries. So there is an issue of, let's recognize that in order for economies to work well in a sustainable way, we need to have sufficient safety margins. Safety margins are buffers. They're buffers in monetary policy, they're buffers in fiscal policy, and so on, in prudential policy. The question to me, that's why which I would like to emphasize over the next decade or so, is going to be how we rebuild buffers. And we build an economy which is not based on the assumption that interest rates have to be so extraordinarily low as they are now, which historically, let me stress, is unprecedented. Unprecedented, okay? We don't want to have an economy which has to be able to function, which is able to function, only when those rates remain at that level. We need an economy which is more resilient, and we need an economy which is more robust. And the question is how we're going to get there.
Claudio, thank you very much for that. And that might be a good place for us to end the discussion. You know, we've already run out of time. So it remains for me to thank the panelists. You know, I thought that that was really a very interesting and very informative discussion. And hopefully we can revisit this issue perhaps in 6 months' time. You know, I'd love to call on all of you to do this again and to see where we are in 6 months' time. One thing I can say with a fair degree of certitude is we are in uncharted waters, and a lot of things are going to happen the next 6 months. So maybe we take stock then. So thank you very much for participating, and thank you everybody for joining us.
Thank you, Desmond.
Thank you very much.
Good discussion.
Thank you.